Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and those 10-year note yields ever so slightly higher. It was kind of a quiet day on Monday. We saw yields uptick ever so slightly. Friday, don't recall, we went out around 277, so we got up about to 279. We're still below 280. And I think it's kind of a yawner here in the Treasury complex. If you look at what's happening over in equities, we saw, big sell-off on Friday, big rally on Monday, and bonds just kind of shrugging their shoulders saying, yeah, what have you done for me lately? And I think that right now, as far as bonds go, your key levels, you got your midpoint of the year, which is around 270. You've got 290 to the 295 to the upside, where we haven't been able to get through. Obviously, the key big level is 3%. Can we get to 3%? Will we get to 3%? I think we will. It's just going to take some more time. It's going to take more Fed policy, more positive data, and perhaps it's going to take some of the CBO expectations of wider budget deficits to narrow a little bit. So there's a lot of good things happening out there. There's a lot of not so good things happening, and Treasuries have just been kind of trading very unreactive, as we're seeing in equities and commodities that are kind of booming around. And if you look at market volatility in the Treasury space, we are up a little bit, but it's not up significantly and still well below what I'd call a level that would cause alarm or fear. So Treasury ahead of key inflation and minutes data. So right now we're seeing ahead of key data, we're seeing the volatility of the market kind of ho-hum. We're seeing Treasury yields nudge up ever so slightly. And what do we have the rest of the week? Yeah, we've got inflation data with CPI and PPI. We've got the March FOMC minutes. Minutes tend to be a little bit more hectic than do the actual meetings, and I think that this could be one of them. Recall that this was Chairman Powell's first meeting as the head, and I think that if you look a little deeper, he did talk about reiterating some of Janet Yellen's policies, gradually moving rates higher. However, I think his style of delivery is a little more succinct. The market will take what he says more literally and not have to go through it with a fine-tooth comb. Likewise, I do think that these minutes tend to uncover a little bit of maybe some of the gray areas that you don't get to see, whether it's through the press conference or in the statement. So this could be a short-term move for bonds. I don't necessarily think we'll break out of the range, but I do suspect that we'll see a trade closer, significantly trade higher or lower, depending on whether these minutes are bullish or hawkish or dovish. And I think that right now they're probably leaning towards being a little more hawkish. I think the Fed wants to kind of engage a little more hawkish tone, given the fact that it took the Fed so long to begin their rate hikes, and now we're looking at the potential for 3 rate hikes in 2018, when I think they wanted to have an expectation of closer to 4. The market has backed off that, so keeping a hawkish tone will keep the market on its toes. But right now, 10-year Treasuries still hovering in that neutral zone. We haven't seen a real bias yet, but again, we've got a lot of data this week, and that could change very quickly. This is Todd Colvin coming to you from the floor of the CME Group.